Good afternoon, everybody. Welcome to our March 15th, eve of St. Patrick's Day Eve edition of Bull Sessions. My name is Mark Robertson. I am joined here by Ken Kavula. Ken, are you wearing green today?
I do have some green on right now, Mark. Yes, I do. It's not official St. Patty's Day, but I still have a little bit of green on. So I bring you greetings from Ione McNeil. She asked me to be sure the next time I was on a webinar with you to give you her best and tell her that she listens as often as she can and she really enjoys these bull sessions.
I appreciate that. I'm supposed to be on with her within the next month or so. Hope you enjoyed your session with Ione.
I did. It was an interesting conversation. I'm not sure that it taught anybody very much, but it was a nice.
Well, good.
Visit hour with somebody that I haven't spoken to for a long time. Yeah. It was a very well done program. Very, very pleased with it.
Yeah, I was thinking we might talk over some of the moments, some fairly precious moments I've had over the last few decades, with the community and some of the leaders, that kind of stuff. I don't know. We'll see where it goes. But as for now, let's go ahead and make another moment here today. Again, St. Patrick's Day looms large. March Madness is always a wonderful time. We'll do a little bit of bracketing here today. We'll talk about Irish Spring. I had held out some hope that Hugh might join us for a special guest appearance here today, but he's clearly pretty busy. But we are going to lean on one of his best practices, at least I consider it a best practice, of shopping when companies are trading near their 52-week lows, and there's actually more of them now than usual. So, and we'll take a look at what those screening results and, what we might have interest in those screening results. And then I want to spend a fairly extensive time going over the Brixtor Hathaway acquisition or purchase of Occidental. We had mentioned it last week, and just want to take a closer look and just kind of walk through how we look at a company like Occidental and try to put it into perspective. And that's what I mean by being in search of four-leaf clovers in the Permian Basin of Texas. Any other thoughts come to mind, Ken? You remember our night at Donnelly's there?
I certainly do remember the night at Donnelly's. It was just a coincidence that we found an Irish pub with the same name as one of our friends from Pittsburgh there, but it was certainly an enjoyable evening. That is a Pittsburgh pub, Donnelly's Irish Pub. Good food, good entertainment. It was just a really nice place to be. I was surprised, Mark, when I reminded myself that I could screen on this idea of comparing my price to the low price for the last 52 weeks. I had, to be honest, I had forgotten that I could screen on that metric in Manifest. And I've been doing that for about the last week and a half, 10 days, and coming up with a list of 6 or 8 stocks that I'd like to add to some of my different portfolios. And so we'll see how close I come to my ideas to your ideas in the same general direction.
I'd be surprised if we didn't land in a similar playing field, and let's see where that takes us. And last but not least, that is the Chicago River. Again, that will be dyed green in a couple days. That's actually a tiny bit of food coloring added to that river. It's amazing how little actually goes into it. And you'll notice that up at the top, I have dyed our river by the bulls in green in side-by-side celebration with St. Patrick's Day. So let's get underway, Ken, before everybody hangs up on us, because they probably want to talk about stocks. We are going to talk about stocks. No investment recommendation is intended. This is all about education and just kind of laying it out. Demonstrating it for illustrative purposes only. It is about education. We'll express some opinions. Everything that we do here is based on the principles, philosophies, methods, and techniques of the modern investment club movement as we've interpreted them. So you will be hearing opinions. Every once in a while we own something we talk about. We try to remember to disclose that. But please, please, please do your own homework before you make any decisions especially if you think about running out and buy any of those Irish Spring companies we're about to talk about. Every month we have a roundtable. I think we're about 2 weeks out from this month's roundtable, Ken, if I'm correct.
You are correct, Mark. A little bit more than 2 weeks, I think. Yeah.
So we will be gathering again on Tuesday evening at 8:30 to share some of our best ideas. If you'd like to be added to an email reminder list for that session and future sessions of the roundtable, send an email to nkabula1@comcast.net. If you have anything else on your mind, our two email addresses are at the bottom of this page. All right. So let's go ahead and talk, first of all, starting with one of our favorite Irishmen, Hugh McManus. One of the things that Hugh likes to do is he has a list of vetted stocks. He literally almost keeps them on an index card or in a sub-portfolio with his brokerage accounts or whatever. But he has this list of companies that he would like to own that he has thoroughly vetted, understands, and basically endorses the companies. And he basically monitors them for any time they get near their 52-week low. And we had actually added, as Ken was just talking, the capability of searching for and sorting based on the proximity or the closeness in terms of a percentage to the 52-week lows. So let's go ahead and put that to work. All right, so what I did is I went to Manifest. I'll demonstrate this offline after the session for those that would like to actually see it in progress. I'm looking for companies that are growing greater than 7%. That's why you see the 7% number up at the top. I just wanted to stay away from the largest of the companies and basically focus in on medium and faster growing companies. Again, in times like this, pretty uncertain, pretty good idea to have financially strong companies, so I limited that to 80. I wanted to see only the top half of the top quintile, or I guess I should say just the top decile quality companies. So quality greater than 90, and then sweet spot plus. And I didn't want to go too high, but I searched for companies that had a projected annual return of 15 to 25%. And then what I have done is in the display of the results is actually rank them by their position. I wanted them to be less than 20%. This should actually be less than, pardon me.
That's what I was just going to indicate, Mark, that there's a mislabeling of that first column, but it all fits now with what you're talking about. Yeah.
I'll fix that when I generate the slides, but less than 20%. And the reason is Hugh just basically gets interested in them when they come within that 20%. So I ranked them. So how do we do, Ken, in terms of companies that you have been interested in lately?
Well, there's a pretty much of a nice overlap. 6 of my top 7 are on this list, so I'm feeling pretty good. I was a little bit more focused on growth, Mark. So my list starts at 9% and goes above for growth. And I was a little bit less, I won't say less focused on quality, but I loosened the quality just a little bit down to 80 rather than 90. So our lists are very similar to each other. They overlap very nicely. I'm counting on this thing. I own 6 of the stocks on this list already, so that's pretty good.
Yeah, and in terms of companies that have been recently featured or mentioned, Maximus, Starbucks comes to mind. Ollie's has been frequently discussed over the last year or so. It's clearly a bargain retailer that's potentially a bargain right now. Just a number of companies there. There's MKS and LCI check in, DR Horton, Western Alliance, of course, one of our favorite best small companies. Malibu Boats has been mentioned in panel sessions. There's just a whole host of companies. I'm actually drawn to Generac. I've been kind of watching that one, the generator suppliers, and I'd like to see it a little more attractive than it is, but it's gotten fairly attractive these days. All right, so what I thought we might do, Ken, is it is bracketology season. By the way, bracketology is a word for a few weeks in March. And basically took these and wanted to look at what we often refer to as the points of view. What do other people, other analysts think of some of these companies, and put those opinions side by side and just kind of decide, if I were going shopping amongst these Irish Spring candidates, what might I be interested in? And just looking across from left to right, those are some pretty good numbers. And these companies all rank, amongst the top 10% of companies that we would be interested in based on their return forecast or their quality ratings in combination. I'm just seeing a whole lot of pretty good stuff, pretty good confirmation in terms of the value line numbers, the relative strength index numbers, down around 30 for many of these. Morningstar likes most of them. I do find it fascinating. Ken and his Lululemon sportswear. Ken and his yoga pants is an image that we still cannot remove from our memory banks.
Oh, come on.
But, Lululemon's the only number on here that kind of sticks out. So I just began whittling. So come along while I whittle, I guess is the way to think of this. So I'm looking over the list. I'm noticing, first of all of these are core. And what do we mean by that? Potentially core in how we would regard the companies. And this is just your quick reminder that if you add the financial strength to the EPS stability and the quality, and that number's above 225, I found it kind of interesting, Ken, that these are all core companies or potentially core companies.
Yeah, I've been using that rule, Mark, except that I do find a gray zone in there somewhere between, 215 and maybe around 240.
Sure.
So that they're in my mind, at least, when I get real specific, I tend to do a little bit of up and down moving with those things. I'm not sure, for example, that one or two of these are actually core.
Mm-hmm.
And I wonder, the last three columns, what do you think about those last three columns as far as reliability is concerned? Maybe even the last four columns, but especially the last two. What do you think of them as far as reliability?
We've kind of tiptoed around that question recently, and I made a note after last week's session to, as soon as I can get some other things out of the way, to do a little bit of research into it. And this slide actually illustrates, Value Line has trouble with young emerging companies and cyclical companies to some extent. So that always should be factored in, as does Morningstar. In this case, the analyst consensus estimates, that's what ACE stands for, they tend to be universally pretty optimistic. I don't know what the efficacy is over time, but we're going to do some digging. And the same is true with that. I think maybe your question revolves around this Expeditors. You've got a 1-year forecast of a 12% total return, yet they look at the long-term price to fair value and see an incredibly, almost too good to be true value. So how do those two actually happen at the same time? I suspect they don't very often. But yeah, it's a question we want to take a look at. Is that what you kind of had in mind?
Yeah, pretty much. Well, I'm interested also, Mark. I'm reasonably certain on the time frame when I look at Value Line low total return.
Mm-hmm.
I'm reasonably certain they're talking 3 to 5 years out, and that's about as defined a time frame as you get a lot of times. What is the time frame as stated in the literature for the next two, though? Do we have an actual time frame, or is it just a number that they print?
I'm fairly sure that when Morningstar does their fair value cash flow based analysis, with their discounting and their modeling, I believe they may be talking about 5, it could be 7 years, something like that. They basically do a stock selection guide standing on their head and backwards when they're doing that, but they have a comparable time horizon. With the analyst consensus, I think it's probably, I would hate to think what that looks like smorgasbord wise.
I'm asking myself if that's not more akin to the timeliness ranking that you see from Morningstar, that it might be as short as 1 year or even less, when you're looking at it.
Yeah, I think they're probably at least a year, at least theoretically, but like I say, with the analyst consensus numbers and that type of stuff, you can be looking at a wide berth of horizons. So, yeah.
And these two groups of aces that we have here are two different groups of analysts, correct?
No,
In the
well,
last two columns?
yeah, they probably vary. They're theoretically the same pool, if that's what you mean, of analysts.
Is it really the same pool? Okay.
Yeah, at least it should be the ones that are grabbed by Y charts. So anyhow, I decided to drop Lamb, Expeditors, Lulu because of that image, and DR Horton just because it has a fairly low value line number. So again, I'm just trying to get down to, what would grab me and possibly get me more interested. I followed that up with the next level of kind of like going beyond the regionals to sectionals, or however you want to think of it. Taking out the ones that had the highest relative strength, so they're least oversold, and the lowest projected return on values, just to kind of whittle the list down. And you can see we'd end up taking out Starbucks and Monster and Garmin, MKSI, which is an awfully good study right now. But again, just trying to get down to what might I be interested in to go a little bit deeper. Ending up with this final four. If I was going to sit down and actually consider studying 4 companies this afternoon, these 4 are probably on the list. Maximus, Ollie's Bargain, T. Rowe Price, and Malibu Boats. And you can see that the numbers for all of these left to right are pretty strong. And there's actually some pretty interesting stories there. What's your, if you had to pick one of those, Ken, what would you go?
I'm not collecting as much data as you are, Mark. I don't have the access to immediate some of this data. So my list contains 2 of the ones that are here, and it's Maximus and Malibu. Those 2 I'm really seriously looking at to begin to whittle away at whatever's going on. I hold a very small position in Malibu right now, and I hold a pretty decent position in Maximus. So they've both been hit pretty hard, and I'm looking now to continue to add to that position. I haven't done any selling of any kind, and that's pretty common for these kind of disruptions. I've decided way back in the mid to late 90s that they weren't going to scare me out of the market. So most of my selling I was doing 5 months ago, 6 months ago, 9 months ago, 10 months ago, and I was selling based on the fact that the companies seemed to me a little bit over stimulated for where I thought they really should be. I don't pay a lot of attention to the predictability of PE values as far as buying is concerned, but I do use them a little bit to help me decide. It's one of the factors I use to help me decide when to jump out of a stock, and I don't jump out of that many on any given year. So I was raising cash, maybe 8 months ago, 6 months ago, 4 months ago. I haven't done any selling at all in the last 3 months, and am looking now to put some of that cash back to work.
Yeah, and I want to thank several of you wrote and had comments about us talking about Tin Cup. Selling several positions back in October and November. Kind of the same thing Ken is talking about. It was just a positioning moment, and I think, again, thank you for your kind remarks. It was just a way for us to share, some of the thinking that was going on. And I didn't know what was going to happen over the next 4 to 5 months. It really is just a matter of keeping things in the position that feels right. Sometimes it is instinctive.
I'll tell you too, Mark, that if you're managing your portfolio based on a return, and if you're trying to stay those 5 points or more above the market, which keeps you in the sweet spot, the last 2 years, with the exception of the last 2.5, 3 months, the last 2 years has seemed almost like a sprint just to stay a little bit behind. It's been very difficult to keep the pars in my portfolios where I'd like them to be because the market's been doing so well. And you buy something to push the par up, and the market turns around and pushes the whole par right back down again. And it's not a negative reason that it's pushing it down. It's pushing it down because the prices have appreciated a whole lot. This is the first time in the last 2.5 months or so where 3 of my 4 major portfolios have moved back healthy into the sweet spot.
Mm-hmm, mm-hmm.
And that I had never experienced that before while using Manifest to help me manage my portfolio, because we had never gone through such a historic positivity in the market, which would cause the market to keep pushing pars in the exact opposite direction that you'd like to be going. So
Yeah,
it's interesting, it's informative, and on top of everything else, it's really educational to my mind on when you should be looking to move money out. And I think it kind of jives real seamlessly with the falling leaves thing that you were talking about a couple of sessions ago, where these companies hitting high after high after high are maybe telling you something about leaving all your money on the table if that's going on for a period of time.
absolutely. And for those out there thinking, boy, I'm hearing an awful lot of talk about selling. I can point to years, multiple years when I sold nothing
Yep,
in some of these
absolute
portfolios.
same thing.
So yeah, so
Same
when
thing. Yeah.
it's not something we get
And
crazy about.
I didn't do a lot of wholesale selling either, Mark. I think I learned my lesson in a couple of my investment clubs that got really aggressive and sold entire positions that were, they in their minds, overvalued, just to find them becoming more and more and more overvalued. When you get into a momentum stock, there's nothing that tells you when the momentum's going to cease sometimes.
Mm-hmm.
And this last couple of years in the market certainly has taught me a lesson about getting rid of really, really high class good stocks. I wasn't afraid to cut a quarter or a third or even half a position, but at the same time, I wasn't out there just dropping names from the portfolio wholesale.
Absolutely. All right, so I thought about doing a poll here, but if you want to comment, which of the 4 would be a favorite and why, I will tell you that I have great respect for some of the work I've actually witnessed from Maximus and the field of opportunity they have. Ollie's is a bit speculative for me. T. Rowe Price, boy, if you think that the waters are choppy ahead and you're looking for some stability, I think it offers that. Plus, I'm intrigued by Matt Spielman's Victory Capital and other companies like Houlihan Lokey in that realm. There's just some interesting signs there, and of course, some of the banks. Malibu, I already own a few shares of, but that continues to shine pretty well. Perform. So I would love to hear your thoughts either in the comments or on the forum. But yeah, so let's go
Mark,
ahead and keep rolling.
before you go much further, Mark, would you do that core calculation again for a couple of our viewers? They're just digesting it and would like to hear it once more.
Yeah,
The numbers that you put together to come up with core, non-core.
yeah. We often get the question core versus non-core. How do you define? Well, first of all, you can't. It isn't the eye of the beholder. But Ken and I sat down one day and said, you know what? Let's take a look at a handful of companies that we think are generally perceived as core versus some that are obviously not, and see if we can't find something. And what we began doing is just looking at, if you take the financial strength of the company, add it to the earnings per share stability, which is just simply the reliability of, and the consistency of a company's performance. And then even though those 2 elements are included in the quality, there's some other stuff there also. And just basically add those 3 characteristics together, you get a number. That number is going to range from 0 to 300. And what we found is that the companies that have this perception that they're core they seem to live above, and this is like Ken said, it's 225 plus or minus, maybe 10, maybe 15, whatever the number is. But once you got above 225 and you had a company in that realm, it it was more likely to be regarded as a candidate to be considered a core company. So that's basically where that comes from, and how it's not cast in concrete by any means. There's at least one. I would even hesitate to call Lamb Research a core company in my portfolio, but it's a great company.
Yeah, our audience is doing, Mark, what we would expect them to do now. They're giving you or me or both of us or everybody points to ponder about some of the companies that are left. I guess I want to make the point that this is just the beginning of making your choices about what you want to add to the portfolio. It's not as simple as just coming up with a list of 20 stocks or so and then drawing lines through those you don't like for one reason or another and buying what's left. You have to submit it to a little bit more due diligence than that. But I'm looking at different people pointing out things about debt, pointing out things about cash flow,
Oh, of course.
pointing, all the kinds of things that you would then take a real hard look at, and either uh, and people don't like it when I say either make an excuse for the number, but that's essentially what you're doing. You're coming up with a reason that in your mind gives it a pass on that particular number, whatever the number happens to be. And the evidence has to be pretty compelling in my head to get past a number that looks kind of gnarly on first blush, So that's Roxy reacting to your list, Mark.
Well,
Okay.
she's upset that I drew a line through Western Alliance. There's no
Okay.
doubt.
Must be it. Must be it.
All right, here's a quick look at Maximus. This is the one of the companies that I would find more interesting. Quite a compelling track record, Ken. I'm pretty sure you're a shareholder in this one.
I am, and we're a shareholder in this company also, in a couple of clubs. In fact, we just did an industry study with the B.I. Baker Model Club. This is the name of this industry that Maximus is business services. It's an industrial sector stock in business services, and we ran 5 companies through the grinder, and Maximus and one other company came out on top as far as our liking it for the industry itself, thinking that it's at or near the top in the industry. So it's interesting that you bring it up today.
Yeah, I mean, we're looking at 10% growth, fairly consistent margins. It does seem like there was something of a downshift here in the business model, but this is certainly a pretty compelling profitability picture. And so you end up with a company that's anywhere from, the projected return on value is at 12. The par, this par is basically suggesting that PE might be a tiny bit high. So in a detailed study of this company, I might shave a couple points off that PE, or at least ponder it. But pretty good stuff top to bottom. And again, one of the reasons it's on this page to begin with is it's trading at the very low end of its 52-week range, very close to that 52-week low and the Irish Spring qualification. All right, so anything else to add on this one, Ken, or should we press on?
It's quite an interesting business. If you don't know what Maximus does, they don't do anything as far as making a product. These folks are managers, and they're hired to manage programs for governments throughout the world, whether they're local governments, state governments, national governments, mostly in English-speaking companies and also in Saudi Arabia. But you might have a program to fund children's health care in your state, and you've set up all the the factors for the program, all the rules and regulations and benchmarks that you'd like to hit, and then you hire Maximus to come in and actually manage the program. So they will set up the software that you can use to keep track of what's going on, and they will set up the detailed analysis that you need to have done to make sure that your rules are consistent. And then they'll actually just manage that program and present to you whatever results you're kind of asking them to gather. And they'll do this all over the world. They have millions and millions of dollars in ongoing contracts. And that's one of the reasons that the clubs that I'm in like this company, that there's a pretty decent visibility out for the next year or two or three, because they sign long-term contracts with these governments. So an awful lot of the earnings stream is something that you can actually see on paper and kind of factor into your analysis. Really interesting company.
Yeah, and I had run into them. I don't remember what the transaction was for, but a Secretary of State transaction here in the state, and it really went delightfully well. And so I got done, and I said, I got to see who actually is responsible for that. I scrolled down to the bottom of the page, and Maximus was actually displayed. So, good stuff. All right, here's just our quick reminder. One of our pictures for the week. There's a lot of reasons to run for the hills, but that picture is pretty much it's not a straight line from point A to point B, but boy, it's a reminder that we go through a lot of stuff. And this is the 13th anniversary of the bottom of the bear market from 2009. So go ahead and pick your favorites there, but just the point is, it's always something, isn't it?
Well, we could also make a curve like this, Mark, and put a lot of things that are on the SSG and on a lot of the tools that we use for analysis. There's always 500 reasons why you don't want to buy a stock, and I feel real lucky when I get a stock that 450 of the 500 things are pointing in the direction I'd like them to be pointing. I don't think you're going to find a perfect company anywhere. And if you want to find reasons for not buying something, I think that's a much easier job than coming up with a good solid case in order to buy, and coming up with reasons why you can, and again, I'll use the word make excuses for the numbers that don't fit your model.
Cognitive disorders. Well, a couple of these jumped out at me. How about this one? Ebola, right next to this one. The Dow falls 1,000 points for the first time ever. You know what we call that condition today? Tuesday.
A blip.
It's a weekly occurrence now, so it obviously wasn't that big a deal. Okay, moving on. Here's another one I found kind of interesting. The top 10 versus this is just 20 years ago. Pretty stunning, I think. And yeah, there's only one company on both sides of the ledger.
That's exactly the first thing I did when I saw this slide. What's the overlap? And only one of them has made it 20 years into the future. I guess that you don't feel the Dow is as dynamic as it really is, because it does change fairly slowly, and they don't make a real big deal about the changes. You don't hear too much about so-and-so being dropped a couple of months after it happens. So it's interesting. I'm surprised that Apple is not in the top 20 in 2000, however.
Yeah,
Maybe
it had to be close. And Johnson & Johnson had to be close also.
Yeah.
All right, pressing on. Here's a quick reminder about diversification. In case you weren't aware of this, the problem is almost as bad in China. And it's probably worse here than I thought, although I think our domestic diversification is probably better than most. A lot of those domestic companies in this golden bar, have a financial component or an international component also.
And even a lot of the Dow has a fairly strong international component to it, Mark.
Yeah. I mean, on average, 40 to 50%, I believe, is classified as non-domestic in most portfolios. And okay, and then I thought we would end on a nice note for St. Patrick's Day, at least this portion of the program. Charlie Bolello really puts out some interesting factoids over time. And he's pointing out that you can pick out the 5 worst years at this point, going back. It looks like he's going back into the 1930s, and check out what actually proceeded following that. And that's kind of a glimmer of hope. It's certainly a glimmer of hope for my Groundhog portfolio, Ken.
It's a glimmer of hope for a lot of the Groundhog portfolios, Mark.
A lot of them need some glimmer. They need a little bit of that leprechaun gold. But
Yeah.
this is one of the reasons, as I discussed last week, I have averaged back in a couple of family portfolios into VGT, and that's a continuing process, along with doing some of the shopping I was just talking about, looking for some interesting individual company bargains also. All right, so that's just your moment of hope for the day. I have no idea when this starts to turn around, but good stuff.
Oh, Mark, we're starting to hear the analyst community reference this particular set of statistics on a pretty regular basis. I listened to a couple of guys yesterday preface their remarks by saying that my bet is hedged to the upside because usually the market is up following a really bad start. And you can see from this, what is this, the 15 worst starts? You can see how often it's up compared to how often it's down. Only one real disaster among all the list, huh?
Yeah, and that's our favorite nasty moment in the market from
2008.
2008, 2009. All
Yeah.
right. Well, the groundhogs are not immune from that previous slide. Here we go. I can't believe how rapidly we've reached conditions that are actually worse than our finish last year. It's early. I'm knocking on wood. All that stuff. I know all that stuff, but boy, it's carnage. But a lot of very familiar names up at the top. Ken has joined the top 40, but it's an interesting day when 5 of the top 10 are runaway rhinos in just one investment club.
I don't remember, Mark, the professionals having such a good looking top of the list, and maybe because this is the first year that we've really focused on the contest right from the very beginning. We usually start to focus on the contest 10, 11 months into the contest. So they've certainly got off to a good start, these professionals have. No matter how we're collecting their portfolios, you can't fault the fact that there's 8 or 9 of them in the top 20.
Yeah,
so
it's I don't think it's normal. Again, not knowing because we haven't watched it that closely, but yeah, it's also a sign that they probably do a little bit more hedging and that kind of stuff. So it is what it is. Kathy continues to get trounced, which is unfortunate because I've included ARC Innovation as one of my groundhog picks. So I'm right there with her. Kim Butcher made the top 42 here, so she insisted that I go down to 42 today.
It's off to the Northern Traders and the North Texas Model Club and the La Miz Model Club up there in the top 15. That's quite an accomplishment in this market. Even though they're not making money, it's still an accomplishment. And a big round of applause for George at this point, George Mackey, to be able to be positive with everything that's gone on since February 2nd. That's quite a feat.
I think I'm going to form a joint venture partnership with George to move up the list. We can form our own little
George, George, stay independent, George. Okay.
A lot of powerful posses in that group. Anyhow, just a reminder that that darn monkey is in the top 10 still, and my new goal for the year is to beat the monkey. I don't care what happens to everybody else. And just a quick reminder on the upper right there that he actually didn't throw darts this year. He picked this stuff out of a Pyrex container, apparently. All right. The monkey bothers me. All right. A quick moment with our best small companies. Actually, half of them are outperforming the market. Some of them doing fairly well. We're not doing that badly. The market outperforms both the active and the completely passive traditional Red Rabbit collection. But again, we do have to. I thought you'd like our picture of the bear there. He rivals the Groundhog from last week, Ken.
Has his hand up. Yeah. What's the red dotted line for, Mark?
That's measuring basically a bear market since October. So
Okay.
that would be a 20% drop. Which, by the way, the Nasdaq actually reached below a 20% decline yesterday. I think officially bear market for the Nasdaq. Well, the Russell 2000 growth category has been in a bear market for a while now, and it's getting challenged. And again, we make the point that a lot of the stuff that we choose from would be more consistent with the companies that are in that growth fund. It's an exchange traded fund, and we have to consider ourselves fortunate that the blue bar and the red bar are actually ahead of the Russell 2000 growth. Ken, I will point out that China continues to have difficulties on a number of fronts. I'm not so sure about Green Tree at this point. I know you've been saying that for several months, so you can just hum while we go through this part. But you know, they shut down quite a bit over there for the Olympics, but things just are pretty crazy. I don't know if you noticed, but Yum China was having trouble. Apparently, they didn't want people to audit the books for the last 3 years, and that tends to make people nervous. There's just a lot of stuff going on in China, and many people think that China may be facing some pressures comparable to what Russia's going through. So I don't know.
Well, it's bothersome to me, Mark, that while the rest of the world seems to be getting a handle on COVID, or at least big portions of the rest of the world, China is locking down again, locking down big time. The number that was used this morning on some of the shows was anywhere from 50 to 65 million people being in lockdown again. And I don't mean lockdown like we experienced in the U.S. here. I mean real, honest to goodness lockdown.
Yep. Challenging times. So we may have a discussion about replacing that one. I don't know. All right. A little perspective. Here's what the Russell 2000 growth ETF has gone through since Halloween. And it's not pretty. But I do find a little bit of consolation in is that it does seem to be finding a bit of a bottom down here. And that's right around the levels shown there. All right. Just a reminder that our roundtable 2 sessions from now, basically a month and a half from now, will be a joint venture with St. Louis. And we look forward to that special program. All right, so let's go ahead and spend a few minutes, 10, 15 minutes, just kind of walking through a little bit of the Brixtor Hathaway thing with Occidental Petroleum. The news on this came out fairly recently, buying basically $7 billion worth of Occidental, which seems like a lot, at a price of just under $60 a share. So that's the general news that's out there, and this is fairly hot off the press and something which has taken place in fairly recent history. Here's a look at what has happened with Occidental. And by the way, we're looking at this, an investment club that I'm going to spend some time with tomorrow night. You're certainly welcome to join in too, Ken. Stocks, they're in Grand Blanc. They asked us to take a look at Occidental. And so that's what we're doing here, kind of walking through, trying to assess the situation. And I think the first instinct that kicks in for me is this notion of don't buy it simply because you read it in the newspaper, that Buffett, and that's in quotes because it's not him personally, has bought it, and instead work on finding the one that they'd want to buy next. And that's kind of words to live by, I think. All right. And from that, here's a quick look, and then we're going to actually walk through a lot of the stuff of what's going on at Occidental. You can basically kind of discount or disregard anything on the left-hand side up through 2018. There was actually some divestitures and an acquisition of Anadarko in 2019. So really the 2019 going forward on any type of representative business model is what you want to pay some attention to, and that's where the trend line is drawn through. Value line is looking for 9.5 or 10% growth for this company. We're looking at basically 9%, so we're looking at this situation and that red line. Fairly consistent operating margins over the years. Fairly easy to squint and decide that 50-ish makes some sense to us. PE ratio, that's where things get a little bit dicey. We're going to talk a little bit more about that, but we are looking at a company even after Brixtor Hathaway has pumped up the price a little bit, although I think it's dropped back down to 55 or less today. Not quite as much on sale as it was, but perhaps even more than we understand. Why do I say that? This projected return on value is still pretty high, so we want to take a close look at that as we go through. And just some other indications. As far as the general predictability of the company, it's a landmine. No way to put it other than, those earnings are pretty erratic. And it's in a cyclical industry. Any thoughts from 35,000 feet as we launch into it, Ken?
I'm just going to sit back and listen, Mark. You know that I find it challenging to study the energy sector, and I can't make enough allowances a lot of times for what the companies are doing to want to dip my foot into into buying any of them. So I'll just sit back and listen. Okay.
Okay. Yeah, I think the company actually provides a pretty good case study of how challenging this stuff can be. This captures it pretty well. You're looking at the bottom line net profit margin over time, and anytime it dips down to zero or negative, it really is harmful to our stock selection guide, which doesn't like negative numbers. And then there are a number of years down here, if we're going to forecast a future price based on the earnings and the price to earnings, there's quite a few gaps in here. Now, this is a good company in its field, but it just naturally is subjected to the tidal waves of what's actually going on in the business environment. So again, they tend to handle the waves pretty well, but they're just a reality. Here's a quick look at the front page of the stock selection guide, just to make the point that, if you ignore the pre-Anadarko acquisition and just kind of focus on stuff to the right of the line, you have less information to really pay much attention to. And again, keep in mind that the analysts who cover this company longer term are looking at upper single-digit growth, and that's defensible, in my opinion, from this picture, including those 3 years of estimates that are out in here. The overall trend through those data points does make a little bit of sense. When it comes to the earnings, though, that's a tough one. So again, you can start to see for a beginner, and this is why we suggest that anybody that's fairly new to investing avoid these type of companies. Very cyclical, the information is just full of turbulence, and really tough to make a judgment call from. We'll see more of that as we go along. That's where this dude comes in. We've talked about it for months. One of the things that the projected return on enterprise value can do, because it takes some of the turbulence at the bottom line away by focusing on the top line, which we do on the stock selection guide anyhow. And again, a little more emphasis on a little further up the income statement, either cash flow or earnings before. I can see I've got a typo there again too. I'm going to have to fix a lot of stuff in this presentation, Ken. It must be my medications. That should be EBITDA, earnings before interest, taxes, depreciation, and amortization. So it's just a different point in the curve. Think of it as pre-tax or operating income. But again, it's going back to the original days of the stock selection guide. And then for a company like this, it does kind of remove the PE a little bit. I mean, you need the PE, and we'll look at that, but it does. Here's the business environment that you're basically talking about. And I was using this with a group the other night. I actually had a picture of this that I had taken to tennis because nobody could remember that gas prices were higher in 2008 than they are now. And some people have trouble believing that, but look at the turbulence in the selling price. That's dollars per barrel up here at the top over the last 10 years, but then go back and even look back at this period in time. And I think part of the business thesis of what Brixtor Hathaway is doing is basically looking at how the company persisted following this moment in time. And they're noticing that we just had one of those not that long ago here. So just kind of keep that picture in mind as we go forward. They're basically looking at a company recovering as the price at the pump takes off. All right, so here's some other stuff to look at. Again, right off the value line sheet for Occidental, you can pull the sales, you can pull the operating margin, and you start to build that picture. And the reason we're doing that is we just want to have a better understanding of what is our expectation for out here. And then what does that look like on an operating income basis over time? And again, closer it up straight and parallel, I suppose, if you really want to stretch it a bit. But the reason we do that is we really need that projected operating income, whether you read it off the graph or calculate it, in order to do the projected return on value. For the projected return on value, just like is shown down here at the bottom, we need that right off the SSG, or because you can't really find this anywhere, you need a projected operating income. That's the 20 billion that you see here. And then in the denominator, again, the enterprise value is the market cap, which is the stock price times the number of shares out there. Total liabilities, which we think is better than tracking the debt, long-term debt, and then of course the cash in the account. So those three numbers are all provided right here. We end up with a projected return on value. It's kind of part two of the thesis, I think. I think that the projected return on value for this company was way outsized compared to other companies, especially under the $30 to $40 price tag not too long ago. Again, this number, the operating margin, less turbulent, a little bit easier to sink your teeth into and say, 50% plus or minus 10 going forward. Any comments on this, Ken? Or are you still sitting back?
Well, I'm interested in some comments that I heard in the last couple of days about analyzing these oil stocks, and it seems to match where you're at a little bit, Mark. And the people that were discussing it were very clear that these spot prices that are the news movers, the $115 a barrel, $120 a barrel, $128 a barrel prices, those are spot prices that you would have to pay if you were buying it today for delivery today. But people that really use oil depend on the future prices. And oil futures are really down in the low 90s, high 80s. And if you go out 6 months, they're even down into the low 80s. And that's where the price of the oil companies tends to follow those futures, which are looking out 4, 5, 6 months. This begins to all kind of fit together with what you're saying here. I'm wondering why the numbers aren't any higher than they are, and yet if you're looking at the futures out 6 to 8 months, maybe the market's already discounted some of the angst that's sitting around the world right now, and looking for a little bit more rational method to value the oil. So it's interesting. I just decided, Mark, a long time ago that I didn't like oil. I wasn't going to try to go through the ups and downs of oil, and I was going to focus on other kinds of stocks. I found that you could be a pretty successful investor and ignore energy for the most part in your portfolio without a lot of harm being done to the portfolio. That was true when oil was a much larger part of the stock market than it
Mm-hmm.
is today. And today, oil is a continually shrinking part of the stock market. I don't think it's going to go away. It's always going to be an important commodity in the foreseeable future. But I think you can afford to ignore it and uh, not put a lot of your portfolio at risk.
Absolutely, and that's actually part of what we'll discover here also. One of the things that we have liked about the projected return on value is that it's relatively few numbers and they're pretty easy to put your hands on. Using just Morningstar, you can go and you can grab the market cap, or you can calculate it, whatever you prefer. Depends on who you are, but here's the market cap, here's the total liabilities, and here's the cash. So the only number that you're calculating at this point is that number off the stock selection guide that we've already demonstrated, that operating income or earnings before all that other stuff. And again, we're dealing with crayons here. We're not trying to get too obsessed with some of this stuff. So what you end up with, if you were to use a PE in the 14 range, a company with a projected annual return down around 11 or so, basically, I believe, and this is kind of part of the thesis also, Ken just mentioned it, if the futures price does end up in that 70, 80, 90 range, that's very attractive to the companies in the Permian Basin in terms of how that compares to their cost of production. And it's my understanding that as many as 17 new rigs are being installed per week in the Permian Basin right now, despite what you hear on TV. That is kind of what's going on. But what I do want to kind of draw our attention to is, again, when you're doing a stock selection guide, it's not a traditional stock selection guide. We say it's not for beginners. The reason for that is, how do you predict what lies ahead for this animal here? That's the earnings. Or how do you predict the PE ratio looking at that picture? That's really the kind of the crux of it all. But here's a look at what the PE ratio looks like on a stock selection guide. I'm not sure what you do with it. I think you do want to end up in the low teens at the most for the average. I crossed out 17 as a kind of a weird year, and you're down into that's probably credible. But again, anytime that you're crossing out that much information and there's that much information that's NMF, that means not meaningful, it becomes difficult to build an image of what that might look like in the future. When that is true, although I picked some numbers here, I tend to disregard all of this stuff if I'm doing a traditional stock selection guide and go straight to this beast and just basically look at, well, if it's gotten bad recently, how bad? And basically select the recent low price for the market, in this case all the way down at $8. And that does provide some form of protection even for experienced investors behaving like beginners. It just basically suggests that this thing is not quite as attractive at the current level as it was at $30 or $40 a share, and that's just a logical conclusion. And then just working the way down the chart, the 5-year potential, is it something that would remain fairly attractive in that $60 price range where Brixtor Hathaway is adding shares? And I would argue maybe not. This comes in on the PE as at a default of about 82. I would just urge caution, go down, and here's the long-term look at payout ratio, also known as average annual dividend yield. Actually, this column right here, all dividends to net profit is basically the payout ratio. You can see it closer to 40 than 80, and that gets you to a yield of 3% or so. And just make sure that you watch for that, because I think this started off at about 8 or 9%. That's not happening. So again, a fairly vanilla forecast for the company at its current price level. And again, just as a reminder how challenging it looks on the front side with all those
Well,
peaks and valleys.
and the one thing, Mark, if you could go back to that slide, the one thing that I think that if you've moved to a stage in investing where you're comfortable with being a long-term investor, then if you're going to buy stocks like this, you have to become comfortable with one or two of your stocks having no earnings for 2 or 3 years. You have to be able to say, well, I'm in for a penny, I'm in for a pound, and I'm gonna work through it. That takes it's easy to say. It takes a fantastic amount of personal discipline, however, to keep a stock in your portfolio that is negative in earnings for a year, let alone 2 or 3 years. And that's what we're looking at this blue line chart here.
Mm-hmm. And this does dovetail with the discussions that Len Douglas has led on. It's not all about gasoline in automobiles. There's just a whole lot of stuff
Yeah.
involved here. These guys do an awful lot in the chemical side of the business also. So again, just in summary, you're basically looking at a situation where it probably is pretty good. It's probably a pretty good speculation for Berkshire Hathaway based on where they started, but it's a pretty tough situation now. I was also asked by this investment club to just kind of walk through some of the other stuff that I look at when I'm looking at any company. In this case, the run-up since the news on Berkshire Hathaway came out has resulted in a relative strength indexes way up here. Be really careful if you're looking at a stock that has a really overbought relative strength index. That's one of the things we look at. One of the other things that we look at is the average effective interest rate. And you can take that right off of the value line page, looking at how much are their interest payments versus what is their principal when it comes to long-term debt. This one divided by this one gives you this interest rate. That's actually fairly high, which is basically suggesting that anybody that would loan money to Occidental, as good a company as it is seen as a little bit higher financial risk. So that's just the reality. Notice that is reflected in the value line financial strength C++.
I'm laughing because that set of numbers right there that you're pointing to could be written in English as your guess is as good as mine.
Yeah, that predictability is not real strong. All right. And then in keeping with today's theme, the position in the price range, the target price, according to the analysts, is up around 60. It's there. So again, I would be extremely careful unless you're a time traveler and you know what's going to happen. Couple other things that I will look at. I know many of you do this also. Again, accounting for the fact that value line is often challenged by companies like this and early stage companies. But again, we're looking at a relatively low return forecast, not terribly attractive. We're also looking at Morningstar, equally challenged by cyclical companies, not terribly attractive. And there's the long-term picture of price to fair value, and you can see that they have nudged up above the fair value fairly recently with the Berkshire Hathaway activity. Here's the final thesis point that I think it really boils down to, and I want everybody to at least acknowledge that Buffett has acknowledged the amount of challenge and the number of disasters he's had as an investor in the airlines and some of the more cyclical companies over the years. So they're doing it again. I look at this chart, which shows the exploration and production companies, some of the larger ones by market cap. And I think going back just a few weeks to when you had a market cap in the 30s, in the mid 30s, against an enterprise value. And again, look at some of these comparisons. Conoco's pretty close to it. EOG is pretty close. Canadian, Pioneer, again, fairly close to the enterprise value. Then you've got this beast right here, where this number was actually down closer to 70 at the time. So basically 35 versus 70, which one is different than all the others here? I think, and this is my personal conjecture about what the Berkshire Hathaway stock selection people were sitting there looking at. They're like, this one is so much not like the others. This is a worthy speculation. that that market cap should be approaching that enterprise value. It does for 6 of the other 7, and I think they basically picked a moment in time to take a dive into to Occidental because of this discrepancy right here, this differential between the market cap and the enterprise value. So I'd also like to leave you with this reality. $7 billion worth of Occidental is less than 1% of their investable assets. So are they being reckless? Betting the farm? No, not at all. And then this one I found also, or a friend had sent this to me. I think we want to take a look at this. Maybe it's your homework assignment for next week. What did Dillard's look like back in October 2020? How did it look to us? And what might we have noticed? Because this is a pretty good investment, a pretty good result, at least so far, on Dillard's. Saw some good clean funds. So that's my theory on what's going on. Just wanted to cover how challenging it can be to do a stock study on a company like this. I'm with Ken. I very rarely ever dabble in this kind of stuff. The only other time I can think of, and this was a piggyback on Hugh McManus, our Irish buddy, back when the BP oil spill stopped, and we actually invested in BP. My reason was because they were so nice to us at Better Investing, but no, I'm kidding. That was just an opportunity. Again, we've archived these sessions on YouTube. Take a look there. Subscribe if you haven't, and you'll be notified anytime there's new content, and we're doing some other stuff there. In keeping with our theme, this is from just 2 years ago, guys. I took that picture. Hard to believe, huh, Ken? Ken, are you still with us, or did you fall asleep?
Hello, can you hear me?
I can hear you. Did you nod off?
No, I evidently kicked my mute button here. I can remember just less than 6 months ago when in the Flint area here, gas was right at $2 a gallon. So yeah, it happens. What gets me a little bit, twists my panties in a knot sometimes, is the people telling me that they're going to go from where they were a week ago to the poorhouse because of a tank of gas. I really, really don't think that unless you're driving, a couple hundred miles a day, that a tank of gas is going to put a permanent crimp in most people's budgets. It might stretch you a little bit. If it lasts for a long time, you might have to rethink how much you're driving. But these pain at the pump exposés on all the news channels remind me of the blizzard is coming, or we're going to have 3 feet of water, submerge us in the next rainstorm. This kind of stuff. I just can't figure it out. Maybe I'm not aware enough to understand what's happening.
Yeah, I file it in the same file as your observations about a few quarter point increases in the interest rates and how that sends us all into a tizzy. And then we'll say goodbye with one last slide. Beware the Ides of March. So that one's for Nick DiVirgilio.
Et tu, Brute. Okay.
All right. So thanks, everybody. I will post these up on the forum, and everybody be safe out there. Commence March Madness. Good luck to your favorite teams, especially if they involve orange and blue. But thanks, Ken, and we'll see you next time.
Thanks, everybody, for coming. We appreciate your attendance. See you next Tuesday.